Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. The SBIA is the Association of Senior Investment Professionals focused on the lower middle market, whose members represent the entire private capital ecosystem. It is an alliance for professional fellowship, business opportunities, innovation, regulatory expertise, and market data. For over 60 years now, SBIA continues to work on behalf of its members as a tireless advocate for policies that promote competitive markets and robust domestic investment for growing small businesses. We're pleased to bring you our Lunch and Learn webinar series with today's session, the annual PNC Mezzanine Capital State of the Market Survey. Our educational webinars provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. I'd like to get us started today with a quick question for the group. In your GoToWebinar menu bar, you'll see the questions feature. If you could, please let us know if your firm participated in this year's 2020 PNC Mezzanine Survey. Just a quick yes or no. Thanks so much. And while you're doing that, a few housekeeping items. If you have questions for Preston during the presentation, please use the questions feature in your menu bar. Also, please use this feature to let us know if you're having technical issues. Today's technical director, Ali Kaunaki, will reply with suggestions. Please be advised that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded. The information shared in today's webinar and the archived broadcast are for your personal use only. It's a pleasure to welcome today's speaker, Preston Walsh with PNC Mezzanine Capital. Preston is a director of American Greastick, American Track Holdings, Magnum Magnetics, and Thaler Machine, and he has oversight responsibility for PNC Mezzanine's investments in Salient Federal Solutions and True Temper. Before joining PNC in 1995, Preston was an analyst with Brentwood Associates, a venture capital and leveraged buyout firm, and prior to that, he was an analyst in the merchant banking division of Morgan Stanley. During business school, Preston was an associate at Crescent Capital Corporation, where he focused on below investment grade and mezzanine securities. Let's take a quick look at some of your replies. It looks like most of you did participate in the survey. Thank you, and we appreciate your engagement. If you have questions during the webinar, please use this feature, and Preston will address them at the end of his presentation. Preston, it's my pleasure now to turn the virtual podium over to you to get our session started.
Thank you, Mary Brown. I also want to thank everyone who participated in the survey. It was a more difficult year to get data this year than most, but a lot of you continue to participate, and I think we got an adequate sample to draw some conclusions from, so I appreciate that very much. I also want to extend my thanks to Lamar Horn and Michelle Green from my team that were principally responsible for preparing all the materials that we can go through today. So I'll get right into the results of the survey. I think there's some interesting learnings here. I think we debated with the SBA whether or not people would find this valuable this year, and it quickly came to the conclusion that this was the right year to continue doing this, because I think there's a lot of questions that hopefully will give some insight in terms of what the market is saying about activity levels this year. What I'll say is that we tried to survey additional people. The respondents here are a very static pool at this point, so it's a real reflection on a group of very kind of traditional mezzanine lenders that over time their source of capital is morphed into an SBIC type pool. The responses this year, I think, we had some people drop off, and we'll share with you which categories that fell in. Most of the responses we got were from active companies, and a lot of the SBA companies were active this year. So, the purpose for the SBA and the SBIC with respect to how it was put together by the government seems to be working, particularly in a market downturn this year. But the response group that we had, I think that we had 8 less than last year. I'm hoping we get some more people back last year. I think it was a combination of not being active, a few companies not being in the business anymore, and mostly related to, hey, we're not that active this year because of COVID, so we're skipping the survey. Hopefully we get them back next year. So we can flip to the next slide. What the survey data showed in general is that because we asked for people's last deal, we got a mix of deals prior to March and the onset of the shutdowns as a result of COVID, and then deals more recently. So, and our observation was the market took several months off during the year to try to reset itself and understand what the expectations are and what we could lend to. I think that at this point, we'll talk about current market conditions. Current market conditions, and we've seen it, and it's showing up in the numbers that people are reporting in the survey, are that deal flow has picked up, but there still remains a scarcity value in the deals, and the supply of capital, it remains very high. That overhang that we've talked about year over year on the equity side has not gone down, and some of those have had a greater sense of urgency, having been sidelined for 6 to 9 months. With the result is that on the equity side, we're seeing higher multiples being paid. I think our group has lasted, by my count, about half a dozen deals in the last 6 weeks or so that all are related to us backing a sponsor group that it was very interested in buying a business, thought they were being competitive, and got beat by half a turn to a turn of multiple. I would say that the continued dominance of the cash flow lending market is the non-bank lenders. They've pulled back slightly as a result. I don't know if that's changed in the last month, but that's what the survey seems to show. And what we're reporting on here is the way the group here, the responding group, sees the mezzanine market is relatively stable or slightly less competitive from a competitive standpoint. And what we'll see, and we'll go through this in the survey, is while IRRs are down, spreads are up because interest rates have dropped even more than that in the last year. And the distinctions with respect to where IRRs are higher have to do with the traditional thing, size and role of the mezzanine provider. And then we also have noticed, and this is an interesting data point that Lamar really dug into, we tried to bifurcate the data between prior to COVID and after COVID, and what you'll see is leverage multiples are slightly down, and that in fact was the only statistic where we noted a significant change from the pre-COVID to post-COVID deals that were reported. So moving on to the next slide. What you see in the transaction timing is the timing of the average months between transactions is starting to reflect more like the last recession. Although I think at the height we had an average of 5 to 6 months per transactions in the survey in 2009. So while deal flow has stretched, what you see is a handful of deals prior. This slide will show you the handful of deals, 8 months and longer from the groups that haven't been as active of late, and then quite a few deals that have closed very recently within the last 2 months. As the market has picked up and people have gotten back to the deal business. Moving on. This just gets a sense of the participants in the slide. What you'll see is we had a couple BDCs not able to respond this year, or moving on to different things, or just doing senior only type of deals. And what we really do get from this survey is what lower middle market mezzanine oriented funds are. And what the current fund sizes and the changes there are really a result of the mix of the respondents this year, which is on the next slide. As you can see from the last few years, the SBIC, and I think this has to do more with respondents than who's active in the market. We lost some BDCs in responding, and the excuse was typically we didn't do anything like this year. And then, traditional mezzanine, 1 or 2 of those have moved over to raising the SBIC fund. And this is kind of the mix of what we're sampling now in this industry, which is probably among the reasons that the SBIA has asked me to continue to do this survey through them. Next slide, please. The data collected over year has been very static. I think we've been going on doing this for 16 or 17 years at this point. And the idea is by collecting this data, but not making it too over comprehensive, we can get some respondents and make sure we're a bit able to look at trends over the long term on a consistent data set. The next slide. And what you do see this year in terms of deals getting done is a continuing trend that the deals that are available to the traditional mezzanine market are smaller and smaller. So you see another kind of a downtick this year. I'm wondering if that's going to be an artifact for 2020, because I do think that the opportunity set over the next year for mezzanine providers is increased, and we'll talk about this as when we get to the leverage section. But I do think there's a little bit of an increase in the opportunity set, which may help us in terms of overall deal size for the portfolio companies that we're investing in. Next slide, please. What you do see here, and it was somewhat of our experience, is that, you know, generally in the deals that are getting done this year, they've been focused on, you know, at the beginning of the year that the economy growth was had been very long, and so people were getting naturally more conservative, expecting a downturn to happen. Now that the downturn has happened in some part and is continuing to, you know, there's a weight on the economy now from an employment standpoint. The businesses that have held up better are service businesses, and that's the thing that appeals to mezzanine investors, is they're looking for stable cash flow. So we have a little bit of a higher, I think this is the highest percentage of service businesses in the history of the survey, although they did bounce up as well in the prior recession. Next slide, please. So what we see here, and this is what I was hinting at a little bit, and it, you know, since the survey is before and after COVID, I'm hoping that this is illustrative of a point that will be going forward for us as mezzanine providers. There's a little more dollars invested in every deal in the mezzanine category compared to the deal size than there has been in last year, and going back over the few prior years. The mezzanine part of this was getting squoze down more and more. I'm hopeful that this is indicative of an ongoing trend going into next year, that there's more mezzanine investment dollars available on each deal. Moving on to the next slide. And what we see here, and I'm going to highlight this now, and then we'll kind of, this will be an ongoing theme throughout the presentation, is that the deals that we are doing this year from a risk standpoint, you know, what we see is while IRRs have gone down, coupon and fees have not really moved, and we'll see the data that supports that. And what you see here is that there's a much larger percentage than there has been at any time in the past of the traditional mezzanine providers doing a sub-debt only deal, and really saying, look, I don't want to take return risk on the volatility of the economy going forward, so I'm going to take, rather than respond and drop my interest rate because interest rates have gone down, I'm going to take the same interest rate, but I'm gonna minimize the amount of equity I'm buying because I'm just not as confident. I'd rather trade for certainty of return. Next slide, please. And then we'll get right into the data coming out of the survey, which I'm going to continue with this theme I started on the previous page. The last couple years, what we're seeing, and what you see here is the coupons really haven't changed materially. You know, this year the average maybe have gone up a little bit. But I would say that in the artifact of the survey, and depending on, because we lost the respondents on the BDC side, which tended to be low, probably on average, the coupons are relatively the same that they've been over the last few years. Next slide, please. And the fees really do never change. It's funny, I've been saying this for all the years I've ever done the survey, and every now and then people don't charge a fee, but most often the far preponderance of fees are right around the 2% level. Next page. Similarly, maturities are very static between 5 and 6 years, and that's just the way the market has evolved, and we haven't really seen any departures from there. Next slide, please. Now this slide was very interesting, and this is where Lamar was able to help me and do some really good work. You know, as we got into this, one of our hypotheses we were interested in finding out was, you know, we had a handful of data points post-COVID that showed that the lending multiples may be down a quarter to a half a turn in the market, but, you know, found concluded that there were too few data points that we're seeing in our group to really come to any conclusion. So while we see overall that year to year leverage multiples haven't changed, and typically have not changed for this industry for a really long time, with the focus on the lower middle market that we've had, when Lamar cut the data between deals, longer than 5 months ago, and the more recent deals, what we found was that leverage was down that, roughly quarter of a point to potentially half a point in the current deals that were being done. Now, having said that, the current deals that are being done were over the last 2 to 3 months, including some deals from the summertime, where there might have been a interim reaction, which is different than the amount of liquidity than the Fed has put in the economy. So going forward in the next couple months, the leverage levels may bounce right back to where they were prior to COVID, but at least at this data sample, we did see a difference. And interestingly enough, Lamar did the work to compare out the other parameters of output we got on the survey pre and post COVID, and there wasn't a real material difference except for the leverage. Go on to the next slide, please. So going back to the original discussion we had on the pie chart where a lot of people did sub-debt only deals, you see that illustrated here, where this is among the lowest points that we've had. Clearly 2018 was a very competitive a year from a equity participant standpoint. There were a decent number of percentages of deals with warrants, and there were a decent number of percentage of equity buy-in. But 2018, and when you look prior to that, we usually see 80 to 100% of deals that have some kind of equity participation. This was a compression this year. And I think there's a number of things going on here that we'll talk about when we get to the IRR page. But people in general, on average, were more comfortable taking the returns in the coupon because that was viewed as more certainty. And you see that risk, the risk on decisions that the collective mezzanine market is making by holding tight to the coupon in an interest declining environment, but being willing to give up on the equity side or not take as much equity in this current crop of deals. Next slide, please. And so what you see is an overall reported IRRs are down by half a point to a full point, which is a lot less than the 1.2% drop in treasury rates during the time. So spreads have improved and are about as high as they've ever been on a reported basis in terms of our asset class. And again, it's the mix of holding fast to the coupon and the fee and having a lower equity return. I also think that IRRs are an output, and what we've seen with the aggressive multiples being paid for companies on the equity side is there's probably some aspect of this that is the equity returns are lower that are getting blended into the overall IRR. So not only are we taking less equity, but those returns that blend, we used to be blending in a 20% plus IRR in the equity. I'd argue it was mid-teens or slightly better that are getting blended into the IRRs at this point from an equity standpoint. Next slide, please. And this is just another cut of the same IRR page to get a little more granularity. Next page. So just to summarize the output that we saw from the survey in terms of key pricing terms, as I mentioned before, coupon rates and fees have been relatively consistent or slightly up this year. And again, I think that's probably artifact from missing a couple of the BDC respondents that we've had in the past. But the fewer deals with equity, and I would argue that the IRRs that were reported here are reflective of that lower equity component and the equity that's being blended in. And this is something you can't survey for, but it corresponds with our experience that we're living in the market, that the equity returns are lower that are getting blended in. And so the overall IRRs are being compressed in terms of what we thought, but again, not at the same rate as overall interest rates. Next slide, please. So this is the area where we kind of go in and say, okay, what are the things that influence IRRs that we've reported? Clearly, this slide has remained very consistent year over year. This just illustrates that leverage higher leverage doesn't dictate where the IRRs are been. It's really more of a size issue. So higher leverage is correspondent with larger deal sizes, which tend to be more competitive from a capital market standpoint. So really no conclusion to be drawn from this slide. Next slide, please. And this is the IRR by company revenue, and this is very consistent over year over year. And what you see is the larger companies are more competitive, and their IRR expectations, because of the perceived or real less risk of having a larger company, are lower. and you do get a pretty wide bifurcation of the smaller type company revenues in terms of the overall IRR expected by the mezzanine provider. Next slide. And this is where we actually, you miss some of the data points on the larger size, having missed some of the larger players this year in the survey. Usually we have a few dots that are up toward the 40-50 million dollar range. Again, the mature markets have really kind of compressed, and what you're seeing is the sample that we're creating now is very much a lower middle market sample. Next slide, please. This slide we've always prepared to try to bifurcate as much we can. Usually this is a very consistent slide that the lowest investment size parameters have the highest return. I think you see that generally with respect to the data this year, although there were some deals in the 10 to 20 million dollar range that it spiked up that IRR. So usually this doesn't move around as much as that one slide, but it's generally directionally consistent. Next slide, please. We always try this slide to see if there's any difference in IRR from industry. I will tell you, having looked back at historical slides, they move all around. It doesn't have a lot to do with the industry that you're involved with. It has a lot to do with structure and more importantly, the use of proceeds and the role of the mezzanine provider. Next slide. This slide, I will say that it's really not there because of these small, even having 8 fewer people this year. This sample size in each category doesn't really lead us to a meaningful conclusion, but we can, on the next slide, talk about overall conclusions. Here is probably a slide that is very interesting to all of us because it really divides up the funded sponsor deals that we've been pursuing, which are all in the 14-15% expected IRR range, which is a very consistent IRR expectation with prior years, with the deals that we're doing with fundless sponsors or directly with owner operators. This year, the spread between the two on an overall total basis is 3.3%. That's the highest it's ever been in the survey. Usually it averages about 2 to 2.5% year over year. It is interesting that above the $20 million range, there was a couple deals that were, priced, fairly aggressively that were not funded deals, but that also is a much more competitive marketplace. But when you look at the smaller, really low and middle market deals, there's a dramatic difference between expected IRRs between the funded sponsor and the not funded sponsor deals. And I'm interested in talking about the next slide because this really reflects the sentiment around the data that we found. So everyone's reporting their own individual deal, but then they're talking to what they think about is the sentiment and the market trends. And what jumps off the page here are a couple things. One, that we all think the market from a competition perspective has not changed. And that's not surprising given the data set we came out of here, and that the coupon has not changed, and that the returns have, by and large not changed, even though we reported them as collectively as groups slightly lower. But what has changed, and what we did see when Lamar did the division between pre and post COVID deals, is that the leverage levels are lower, and this is reflected in the sentiment and observations of everyone who participated in the survey. And certainly the scarcity of deals and the impact that's having on the equity multiples and the equity participation in deals is also reflected in everyone's sentiment about the market, with the transaction volumes being lower this year. Next page, please. Now, I think that these move around year to year, but what this really shows is the exit that we've all experienced this year, and of the 42, 36 reported their exits. The multiples haven't changed dramatically, which has been, this is another back-ended way of getting at the overall market. But particularly if you're exiting at the end or the middle of this year, you had companies that were generally holding up despite the challenging economic conditions. And so that the multiples overall really haven't changed in terms of our exits that we've reported. Next slide. We always do take a look at, and this is something where we're making up the average equity buyout target IRR. But as I mentioned on those half a dozen of things that we missed out, those equity IRRs and expectations on a reasonable case had to be really compressed. So and again, we're assuming an honest case in terms of aggregate equity buyout target IRRs. And what this says to you is that while the returns have gone down on an expected basis for mezzanine providers, they have not gone down as much as overall interest rates, and certainly not compressed as much as equity returns, given the deal scarcity value of winning a auction deal or a buyout deal in a post-COVID market. So moving to the conclusion page. So what we're seeing as a result of the survey and our experience is the supply of equity capital hasn't gone away. That was known, and has a greater sense of urgency, having sat on the sidelines for several months. And that's manifested itself in having a higher multiple on some of the deals, not only that we're selling, but also that we're getting involved with. I think that we see that risk-adjusted returns for the mezzanine asset class have certainly improved, because we're talking about slightly lower leverage. We're talking about same coupon and a lot of shift in return to the coupon and the fee at the expense of equity, but that the equity returns have not nearly gone down as much as the interest rates. And in addition, I'd argue that we've already, people were contemplating last year's survey the risk of a downturn. We've certainly had a downturn now, and we're all hopeful that with if we continue to improve employment rates, which is slowed of late, but that some of the risk has been removed by already having the downturn in terms of the investment. So arguably right now, this is probably the highest spreads relative to treasuries and the best risk-adjusted returns if we can get deals, and if the market pace will pick up this year. And I think the key issues for us are all around that next year. There's a large concern that I have about the continuing high unemployment rates just dragging the overall economy down. Default rates have increased. We haven't seen them all now because there's been an artificial suppression of them based on guidance from the Fed to the banks, and a lot of people just kicking the can down the road this year, which continues to have an uncertainty effect on the economy next year, despite what the markets are doing. That those have a lot to do with what the Federal Reserve has been doing. But we all see the market pace picking up. It looks like risk-adjusted returns are very attractive. And now, I put in politics creates uncertainty. I was hoping we'd be done with that uncertainty now. It's still up in the air in a lot of ways, but many things are settled. So I think our outlook is as a industry is very positive, because we're reporting that our returns are good for those of us that are getting after deals. And I think the hope broadly from myself and I'm sure the rest of the people who participate in the survey is that there'd be a better opportunity set in terms of number of companies coming. And by all reports in the investment banks that we talk to, they're really preparing quite a few things to come to market with next year. So I try not to go too far on. I try to illustrate what I could in terms of some insights that we got by looking at the data set here. And at this point, I can open it up to questions, and I'll look to see if there are any in here already. And again, if there are questions, please send them on through the webinar.
Yes, if you have questions, there's a questions feature in the GoToWebinar menu bar on your right. We have had one question come in.
Okay.
You see that in the, rather than mezzanine investors deciding to take less equity, as you suggested, do you think that equity co-investments may not be made available due to increased competition in the market?
I think that's certainly a possibility, and maybe I could have said it that there's less equity being bought. Sometimes it's because of a restriction. We're working on a deal right now that there's just a limited amount of equity we can buy into. So you could characterize it either way. it just shows up in the numbers that there's a little less equity participation this year. And I actually do think, based on some discussions I've had, that's somewhat of a conscious decision by the mezzanine providers to take more of the return in the fixed rate component of the deal.
Thank you. And what was the biggest surprise you found in the data this year?
Well, I think it's interesting. I'm not sure we were surprised when we got the data. I think the biggest change that we had is what has happened to, we haven't had a spread increase in a lot of years. We've had a little bit of an artificial increase based on who's participating in the data going back, but this legitimately is a spread increase with a leverage decline, and that's been a number of years since we've actually seen that as an industry. And we'll see how long it lasts. But I think it's a real positive to have that environment.
Okay, and with the growth of independent sponsor deals, do you see any correlation with that and increased risk of defaults?
I think the independent sponsor deals, I think our experience and other people's experiences that they have had a higher beta. There's something to be said about, and higher beta from an outcomes perspective, because the mezzanine participant is typically putting in a lot more equity. So not only do you have a higher outcome beta, but your securities will have a higher beta in them. And so, they probably default to slightly higher rates, and there's been, the last 4 to 5 years, we've done a lot of them as an industry. And so I think we'll know more in the next couple of years as to how those played out in the kind of the challenge situation that we have. The other thing I will say is sometimes independent sponsor deals, they have an adverse selection risk. If the independent sponsor is winning an auction deal, you have to question, why no funded sponsor won the deal.
Thank you. Has the movement by BDCs into more unitranche and senior, do you see that changing capital access to mezzanine in the middle market?
Could you repeat that?
Sorry, as the movement by BDCs into more unitranche and senior investments, do you see that changing capital access to mezzanine in the middle market? Do you see that changing?
It really depends on what the overall deal flow is, I think. I think that, we saw the BDCs trade down really dramatically during the summer, and they've kind of traded back up as they've been able to kind of push some things down. I think a number of them have some significant challenges, particularly ones that are specifically aligned with certain industry. There's a few that are overexposed to oil and gas. I think what's going to happen is if the market is robust next year, I think they will move more up market where they perceive less risk, and it should create more opportunities, but it really will depend on the supply demand dynamics of the deal flow market as a whole.
Thank you. Are there any other questions out there?
Well, I want to thank everyone for attending, and thank everyone for contributing to the survey. I hope everyone continues to find it helpful, and if you do, we'll continue to try to do it every year.
And we do have one more.
Oh, one more question.
Tourism and hospitality has been hit hard in the COVID epidemic. Do you see any other sector risks?
Well, obviously I mentioned oil and gas, with the oil and gas prices being really down. None of us on the phone are doing real estate and commercial real estate. I think you really have to pick your spots here. Things that are, real estate lease groups that are supported by restaurants. We've certainly had we have a couple restaurant investments. They're pizza, so they're doing relatively well, but shutdowns never help anyone. And then I will say there's a real geographic distribution of impact, depending on which state you're in and what shutdown status you are for some of the certain consumer-facing service businesses.
Okay, thank you. I don't think any others have come in, and we appreciate, as always, you sharing this valuable information with us every year. The members of our industry rely on it and the critical data that you provided today. Our thanks to you and your colleague Lamar Horn for his help in organizing and compiling the data. If there are any other questions that come in, I will share them with Preston, and he and Lamar can respond to them after the webinar. Some people have asked about the presentation. It is in the handouts section of your GoToWebinar menu bar on the right-hand side of your screen, and it will also be shared with SBIA members in email. A replay of today's webinar, along with presentation materials, will be available on our website, where you can review previous webinars and materials. We have one last Lunch and Learn webinar for 2020, SBIC Limited Partners, Past, Present, and Future, coming up in December. Thank you for watching SBIA's social media and daily debriefs for more information. In addition to wrapping up our webinar series, the SBIA is planning a robust offering of virtual, in-person, and small group networking events for 2021. These events are designed to maximize networking, keep you informed on current industry trends, and provide vital advocacy for the lower middle market private equity industry. Stay tuned for details on future events by visiting the SBIA website at sbia.org and by following our LinkedIn and Twitter accounts. If you're not a member of SBIA and would like to learn more about joining our organization, please contact my colleague Alex Frick by emailing membership@sbia.org. Thank you again for participating in our webinar today, and we look forward to having you join us again soon.